Introducing S&P 500. S&P 500 is an index that tracks the performance of 500 largest US companies. And in this video, I'm gonna tell you how to invest in it in 2023. What are the advantages and disadvantages of it? And what are the alternatives to it if you don't want to invest in 490 companies that you don't know, but also if you don't want to spend hours researching individual stocks? Hi, you're on Gainy channel. My name is Paulina and I'm sharing what I learned in 7 years of investing. Let's start with why the S&P 500 is a good asset. First of all, it's easy. You don't have to spend hours comparing different companies, digging into financial metrics. You just buy the whole market. It's like you just buy the whole box of chocolates with different flavors. However, the composition is not always the same. So different companies come and go. For example, in 2020, Tesla entered the S&P 500 index and kicked out apartment investment and management. But fortunately for you, you don't have to care about it because it's automatically rebalanced, so you don't have to buy or sell some extra companies. Secondly, it shows good returns. Over the past 30 years, the S&P 500 index has delivered a compound annual growth rate of 10.7% per year. It's the main benchmark for the rest of the market. So the rest of the players in the market, such as hedge funds, such as large institutions, they try to beat this or at least go at the same rate. Spoiler, unsuccessfully. Over a 20-year period, about 90% of index funds tracking companies of all sizes outperformed their active counterparts. Even over 3 years, more than half of index funds did better, according to a 2020 report, S&P indices versus active. Advantage number 3, safe and diverse. Stocks go up and down all the time. Different sectors perform differently and you never know what's going to be the next big thing or when the inflation is going to rise or fall, if the recession is going to happen, what happens to macroeconomics, how new political leaders going to affect the market. So you understand that the market is super volatile and it all affects different sectors of it, again, differently. Sometimes the big tech is suffering, sometimes it's oil and gas. It's really difficult to predict, and with buying S&P 500, you just buy the whole market, all sectors. Something's going to grow because it benefits from what's happening in the world. For example, like oil and gas now, or something's going to fall because people are saving money and not spending too much on gadgets like big tech now. So it's all kind of balanced within this index. So here you don't have to worry that you've invested everything in green energy or cannabis stocks and it's not growing just because the legislation is not there yet. So this is a good way for you to diversify and stay safe. Number 4, lower costs. Because there is less trading volume than if you were buying individual stocks or selling them. You just buy one ETF and hold it for as long as possible. Then there is less commission that brokers and fund managers can charge you here. Also, the average expense ratio for passive mutual funds is less smaller than for passive ETFs, which is less smaller than, of course, actively managed funds, which is like the range varies from 0.5% to 1.5%. And for passive funds, it's from 0.06 to 0.018 on average. So it's much cheaper for you. Lastly, buying the S&P 500 index is an epitome of passive investing. You just buy and hold it for as long as possible. And if something bad happens, if some companies are underperforming or they close, go bankrupt or whatever, they are kicked out of the S&P 500 index so it stays healthy and continues to grow. However, despite how sweet it sounds, there is one big disadvantage in the S&P 500. It's dispersed returns. What seems to be an advantage, diversification, is also maybe a disadvantage because you under-earn. You could have earned more if you just invested in tech sector or you just invested in Apple, for example. So if you've invested in Apple 5 years ago, you would have grown your capital by 100 500, 87%, as you can see in the chart, whereas S&P only 41%. Why is it like this? Because all companies perform differently. There are trendier sectors like big tech, and there are less popular sectors like utilities. So instead of investing in all of them, you might want to prefer to invest in something trendier, maybe financial sector or energy sector. And you might not want to invest in, I don't know, like insurance or utilities. But I'll tell you about an alternative to investing in S&P a little later. Stay tuned. Another disadvantage is sensitivity to macroeconomic events. If anything happens with the US, you might remember the US-China trade war, so the S&P fell, and also some global events that happened. Of course, the US market is affected by it and index falls. So your portfolio shouldn't consist of just S&P 500 because in terms of the asset classes, it's a bad diversification, and in terms of geography and commodities. So if you want to have exposure to the broad stock market, it's good, but also think about if you want to invest in other countries, in other markets, for example, Chinese market, like now everyone's having recession and they are growing, they're recovering, or you know how bonds, they also tend to be the stabilizer in terms of turmoil. So now let's talk about how to actually invest in S&P in 2023. The first way is to just buy 500 stocks. If you're a millionaire, that might be a way for you, but it's kind of difficult to keep track of 500 companies in your portfolio. It seems like an endless scrolling, so you might not want to do this. Even Warren Buffett doesn't buy it like this. The second way is to buy S&P 500 ETFs in your brokerage accounts. An ETF is an exchange-traded funds. I hope you're familiar with this term. So what it does, it's a basket of securities. So in terms of S&P 500 ETFs, it's a basket of 500 stocks, but you buy it for a smaller amount of money, but you hold all of these companies. So the biggest funds that you can purchase are SPDR S&P 500 ETF, iShares Core S&P 500 ETF, and Vanguard S&P 500 ETF. They differ in price, they differ in commission, they differ in size. Also, not all of them might be available at your broker, so you have to check with your broker what you have and what fits your wishes for how much you want to pay for this. The third way to buy S&P 500 is all 500 companies within this index could be divided into 11 sectors: information technology, healthcare, financials, consumer discretionary, communication services, industrials, consumer staples, energy, utilities, real estate, and materials. So if you want to have broad diversification, you can just buy the S&P 500. If you don't want to include sectors like utilities, you can just buy them in sectors. You can buy S&P indices for just energy, just financials. For example, Financial Select Sector SPDR, ticker XLF, or Technology Select Sector SPDR, ticker you can see in the screen. So you can decide which sectors you want to include and which not to include. And as promised, an alternative to investing in it is invest in TTFs, because you can invest in something that you really believe in or want to support. It's not like you buy the whole technology sector. You can buy specifically AI companies or AR, VR companies or gaming or gambling even companies. So these are model portfolios that consist of 10, 15 best companies within this industry. So at the same time, you stay focused and at the same time diverse, and they are available in Gainy. You can check these lists, see how well they fit your risk profile and portfolio. So I'm going to leave the link in the description below. If you know any other ways to buy S&P 500, or you have more questions about the index or how to buy it, about its performance, let me know in the comments below. And thank you for watching this video on Gainy channel. Subscribe and see you next time.